Dear investors, today I would like to give you a quick update about our allocation recommendation and focus on 3 investment themes. This table gives a bird's-eye view of our allocation recommendation. We are underweight fixed income, especially govies. We have a small preference for credits over government bonds. We have an overweight in cash, equities, and alternative fixed income. Let me now focus on 3 investment themes. Well, yes, 10-year bond yields are breaking above the downward channel that was in place since the great financial crisis. The risks are to the upside. That is because long-term real yields remain very, very low. Central bank normalization also is priced very cautiously. In terms of recommendation, we stick to defensive strategies. Short duration, avoid the belly, the center of the European curve. That means avoid the 5 to 10 year sector. Prefer credit, as I said, especially in short maturities. With the credit curve so flat, we see little value in extending credit duration. This chart shows the close link between rates volatility and credit spreads. As long as the bond sell-off is orderly, we should not worry too much about risk assets. Some technical factors are also supportive. The ECB is buying a bigger share of corporate bonds. In equities, we have seen record inflows this year. This will not continue forever, but again, as long as rates volatility is under control, we will keep a positive bias on risk assets. That said, diversification is of the essence. The correlation between S&P constituents has dropped quite sharply. In this environment, it is good to be diversified. You also need to pick stocks and sectors very cautiously. I remind that we like the oil sector, financials, telecoms, but we are underweight in healthcare equipment, chemicals, and IT hardware. The dollar has been weak despite the rise in US rates. It's always easy to come up with explanation ex post. We would retain 3 factors: the diversification of international reserves, the fact that many economies are catching up with the US, and the US twin deficits. The tax cuts in particular will enlarge the budget deficit. The US has a lack of growth saving, which indeed will keep the US dollar weak in the medium term. Well, the dollar could be the canary in the coal mine. Risk appetite has been very strong, and we should be looking for unexpected disruptions. Dollar weakness might be one. Most importantly, dollar weakness supports the reflation theme. It is positive for commodity, it's positive for EM markets, and eventually that reflation story is negative for fixed income markets. Bonds will continue to sell off this year, and the pace of that sell-off will determine whether risk assets can offer resilience. Thank you.